Welcome back again. As we navigate the evolving landscapes of investment, the debate between cyclicals and seculars gains unprecedented relevance. Which sectors and businesses promise the bigger opportunity over the next 3 years? The question not only challenges but also invites a deliberation on identifying right investment strategies in the context of current market dynamics. PMS AIF World brings us together today to explore this intricate debate. Our panel of experts will dissect this and offer insights into market trends, economic indicators, and investment foresight. As we look towards the future, understanding the nuanced interplay of various factors becomes a key to unlocking significant wealth creation. On that note, let's welcome our next panel. The panelists are Mr. Gaurav Mehta. Mr. Gaurav is the CIO, Alternatives Equity at SBI Funds Management Limited. He joined SBI Funds Management in November 2018 as an equity analyst in SBI Mutual Fund and subsequently moved to having fund management responsibilities as well. Currently, he's responsible for managing equity portion of the portfolio management services and alternative investment funds business. He has over 15 years experience in Indian financial markets, having worked with Ambit Investment Advisors, Ambit Capital, and Novama. Our next panelist is Mr. Kunal Pavaskar. Mr. Kunal joined Tata Asset Management in September 2021 as Principal Officer and Head of Portfolio Management Services. He focuses on business and market cycles and aims to utilize this understanding productively in the investment process. He also likes to incorporate quantitative inputs in addition to the traditional fundamentals-based approach. Over the past 18 years, he has worked with leading organizations including Growth Capital Advisors, Avista Advisory, 361 Asset, and SBI Capital Markets. Mr. Ashish Jagnani. Mr. Ashish is a fund manager at Kotak Mahindra AMC. He joined the Kotak Asset Management in November 2017 as part of the investment team of Kotak Alternative Assets and presently is the fund manager for Kotak Renaissance AIF Fund. He has a total work experience of near 20 years in Indian equity markets and has worked on a few investment banking mandates. Earlier to joining Kotak, Ashish was a senior analyst at UBS Securities India Limited and also held responsibility of UBS India Product Manager. The session will be moderated by Mr. Romit Bharat. Mr. Romit is a co-owner and partner with Akta Capital Advisors LLP. He is a product professional with 23 years of experience in selling PMS, AIF, mutual funds, structured products, and other wealth management solutions, and a leading trainer in the portfolio management and alternate investment space. He has trained more than 15,000 professionals in the next PMS 21A guidelines across companies and platforms like Axis Mutual Fund, Axis Bank, Sundaram Alternates, SBI Funds, and many more. Over to you, Mr. Romit.
Thank you so much. And on behalf of all of us here, I thank you and I congratulate you for the wonderful work. So we welcome you all to this wonderful and informative sessions on a very relevant topic. The moderator justly rightly said that I have been training people on this, and I found this particular topic very relevant because in our pursuit of wealth creations, we often come across a lot of crossroads and factors that determines our outcome in investments and our journey. And I think one of such factors and parameters that define and decides our journey towards wealth creation through PMS is our topic today. In fact, I'm very excited to have with me the three brightest brains and best speakers in this industry. So thank you very much, Kunal, Ashish and Gaurav for being part of the show. So my first question is, as you know, as industry knows me as somebody who gives training, and a lot of people has been taking training. And surprising part is, I get training from not only from the distributors, from the asset managers like you, but a lot of investors nowadays. They are paying money and they train because I train. So my first questions to, uh, you know, uh, to you, Gaurav. I have worked very closely with you and your company. So, what is your investment philosophy and how do your strategy you think is relevant with the topic today? So, over to you, Gaurav.
Right. So, thank you, Romit, and good afternoon, everyone. Rather, good evening, everyone, and thank you so much for having me here. So, Romit, going back to your question, and sort of specifically talking about the topic at hand, which is how do we think of the portfolio, with respect to this entire secular versus cyclical debate. Frankly speaking, we are very bottom up in terms of our stock selection, and to that extent, we are not necessarily really thinking whether this is a secular opportunity or a cyclical opportunity or so on. But I think it will be unfair to say that what happens at the macro cycle level is something that we are blind to. I think that has a very important implication with respect to portfolio construction. And if you zoom out a little, then in a way everything becomes a cycle, right? And for example, if you look at the 2010 to 20 period, and that was a period where a lot of these asset light businesses, especially consumer facing businesses, did very well. But if you think of the macro regime, then globally, interest rates were close to zero. There was hardly any inflation. So I think when a company, let's say consumer company, was to deliver a certain cash flow 20 years out, that cash flow was still valuable in today's money terms, right? Because there was hardly any interest rate, so there was no discount factor. There was hardly any inflation to erode the value of money. But I think what changed over the last 3 years, between 2010 and 2020 and 23, is that you have seen a resurgence of both inflation and, consequently interest rates have moved up. So that same sort of consumer company generating the same cash flow 20 years out, that cash flow has become less relevant today because, interest rates have moved up and inflation has moved higher. And which is why, that 10-year period, anything related to consumer, anything where there was a predictability in cash flow, you bought that between 2010 and 20, it worked well. And 20 onwards, most of these companies have not delivered. And if anything, a lot of these, investment related plays, cyclical plays, commodity plays, capital cycle based plays, value as a theme, that has started to play very well. So I think while we are very bottom up in nature, we are very conscious of these macro trends and the fact that they keep changing, and consequently, for long periods, certain kind of stocks will completely go out of favor is something that we are very cognizant of. And to that extent, we usually run a core satellite kind of an approach where around 50% of our portfolio is these sort of so-called secular long-term compounding opportunities, which is what we call the core. But we also supplement it with the satellite portion, which is about 50% of the portfolio, where we are always on the lookout for where is the positive changes margin from a 2-3 years perspective. And this combination, if you think of core companies, they usually compound at a consistent pace, but the absolute degree of that compounding is not very high, maybe 12, 13, 14%, put a number around that. So it gives you consistency, but not very outsized returns. But when you think of this satellite piece, where you're essentially buying something, ahead of the cycle, and then as the cycle turns, profits expand, and so do multiples, so do valuations, and that gives you some non-linearity in terms of the portfolio construct. So I think this combination of core satellite is something that we think works well, and in a way it also makes the portfolio very relatively immune to these massive shifts that you see in terms of investor preferences with respect to this entire secular versus cyclical debate. So yes, you're very bottom up in nature, but there is this core satellite construct that we work with to navigate these massive changes.
What I really liked about your philosophy is, strategic and a mixture of strategic and tactical asset allocations. Because a lot of times we hear a buy and hold strategy or long only strategy. And I think that has been one of the reasons for, a lot of funds underperforming. Coming back to Ashish, Ashish, my observations has been, a lot of investors nowadays, I find them taking a direct route to investments because with so much of knowledge around, with so much of investment awareness program, there is a sense of belief that I can manage it myself. Let me, and this is a feedback because I train as I've said, I train not only distributors, but I recently conducted, training for 15 clients, and they happens to have a consolidated, surplus of more than 1,000 crores, and they wanted to have an expert advice. How how critical are these factors like cyclical and secular? And what are the challenges when a client tries to do everything out of their own? And how does your investment strategy, happens to, handle these factors? What are your recommendations to clients, with respect to your strategy? So,
Sure, sure. Well, thanks, Romit, and proud to be a part of this panel. I completely agree with you, Romit. This is an environment where I think, at least post-COVID, we've seen everyone, hone the skills of fund management and investment management.
exactly.
And
I see everybody, everybody happens to be, Warren Buffett, I feel good when client sends me a quote of a Warren Buffett. So,
right,
that's
right,
very, very interesting.
right.
Yeah,
No,
sorry.
so you're right that everyone's looking at the best way to position themselves. So we at Kotak, the underlying thread that we have in as our investment philosophy, and which has probably helped us all the way throughout, has been to look at secular growth opportunities, particularly with a very strong underlying thread of earnings growth, and more importantly, that set of companies which are mispriced in markets. So that's like the underlying thread for our philosophy. It helps us to be nimble. It helps us to be reasonable in different times of the markets. Uh, as an approach to market, as Gaurav also highlighted, bottom up remains the core factor. The way we see is that we're not kind of either pro cyclical or just focusing on secular. It's a mix and match of both as we see market conditions. What I try to tell you is that in secular growth opportunities, I think business modes, the visibility of earnings growth and cash flows is something very critical to our entire investment philosophy. As I said, we are not averse to even cyclicals, and I'm sure if you're investing in cyclicals at the right point of the cycle, these are businesses which can really create large alpha generation opportunities. And there are enough instances that we've seen within our experience in markets that this has happened. And I say that because, macro is situations can keep evolving. Uh, and we kind of keep following this very closely. The key is not to predict future because that's something that's out of anyone's control. But I think you kind of prepare with it based on your strategy. And our strategy at Kotak has been, fairly diversified, where we have a good balance of both secular as well as cyclical. Now, when I say secular, businesses like healthcare, technical ER&D plays, home improvements, where we see a decent runway of at least, double-digit kind of earnings growth that you can see. There is a large TAM opportunity that these businesses offer, and that's where we think that there is a place to be in. Similarly, on the cyclical side, opportunities that we've seen like in industrials of late, sometime back in chemicals, energy. I mean, as I said, if you invest in these at the right time, they can be very large alpha generators. Now, the underlying thread continues to be consistent earnings growth and cash flows, and businesses that trade at reasonable valuation. So I think the key advice and the principle that we follow is not necessarily go and buy cheap stocks or businesses which are cheaply valued, but good businesses which have a fair, are trading at reasonable valuation than currently being mispriced by markets. So that's the way we tend to kind of work at Kotak, and that's been our underlying strategy in markets like these.
Brilliant. In fact, what I really liked it about your definition of mispricing. A lot of people, they wrongly assume misprices as cheap. Cheap and misprice is not same, and that's what I have observed over my experience. And obviously, you talk about, indicators that gives you an opportunity for alpha generations. Uh, uh, Kunal, my question to you straight, matlab, now that we have understood what Gaurav and Ashish, where do we think we are in the investment cycle from an economic perspective? Because I think that's what's basic underlying is. So where are we?
So I think we are, and first of all, thanks to you for lovely set of questions that you always started with, and thanks to the team here, Kamal and everyone, for organizing this and other discussions. It's a lovely set of discussions. In the investment cycle, I think we are there's more to go. There is more to go clearly. These things, they are stemming from political economy choices from the government. They are stemming from geopolitical shifts that are happening. Some of them are for example, there are things that are helping Indian companies who are, we talk about India capex that's happening. There is even US capex which is helping some Indian companies in pockets. Companies which are experiencing growth and additional, new segments on the export side in a way that we were not seeing before. So I think there is more to come. I think there is more to come in the investment cycle. And the other, I'd just like to add, what I think is a very good, useful way to even look at seculars and cyclicals. So, we always talk about seculars and cyclicals at a business level. That's our frame of reference always. What this is a secular business and that's a cyclical business. We say that often, and that's right at a business level. What I additionally think as a cut, and some things on the quantitative side help when you look at these numbers. There are return cycles to each of these buckets. I think that's very important, and valuation creates those return cycles. So, for example, Gaurav started and said, how 2010 to 20 was what we saw on the set of secular stories which got re-rated. Valuations go high beyond the point, you can't. It's like the story of Icarus, right? The Greek story. You can't go and touch the sun, and then things correct. And that happened with the entire secular pack. And you could also say at the same time, cyclicals were very cheap at the turning point. And then you have a confluence of starting cheap valuations and the other side being very expensive, and the bottom of reasons for something to start now looking better. When these things come together, they're very powerful. And I think we additionally have to think about secular pockets having their own cycles on returns. And sometimes they can be decade long. And the same with even cyclicals. And if you break it down, Gaurav said 2010 to 2020 was consumers broadly. You could argue that the previous cycle was 2003 to 8. We had a very fantastic investment cycle again, not only in India, Asia, China, right? So very useful to, I think in terms of where are we in valuations for whichever bucket that we're talking of, and what does that then mean for look ahead returns wherever we're sitting.
That's a very interesting perspective, Kunal. What you said is very, very relevant. The cyclicity, or you say the cyclical cycle is not related to business. It related to the returns also. Gaurav, coming to you, matlab, since we are into cyclicals and seculars. So when it comes to an investment manager like all of you, or as my concern has always been that investment is not a very easy business, but the way I see around, I've been always talking around that a lot of investors, thinks they can drive the bus. So between cyclical and secular, how should a manager when I say manager, matlab, it means from the investor's perspective also as a manager, how do they all navigate all this?
Right. So I think I'll sort of answer it from both points of view. How do we, as portfolio managers, think about this, and how should investors themselves think about this? I think as an investment manager, the biggest advantage that I have today is that I have access to a large research team, and probably at SBI Asset Management, we are amongst the largest investment teams in the country. And there'll be roughly around mid to 40 odd people research. Some of them are on fixed income research, some of them are on sort of lateral research like economics and ESG and so on. But there'll be at least 18 odd individuals on equity research. And they've been covering about 300 to 400 stocks between themselves for the last several years. And to that extent, I think that allows us two things. A, they are able to go very deep in their coverage because they've been looking at the same set of names for the last 10, 15, 20 years. And to that extent, they are very in depth with respect to sort of their ability to understand these businesses. And at the same time, because they've been looking at the same businesses for so long, they also have a lot of time to spend on the ground. Meeting policy experts, meeting industry experts, meeting ex-employees and veterans, and so on. And that also helps them get some sense on any trends as they are evolving. So when you look at this combination, to the extent that they are very in depth with their coverage, I think that helps us shape the core part of our portfolio because then, we are sure that we can hold these stocks for the next 5, 10, 15 years also. And then to the extent that they're also spending a lot of time on the ground, that essentially gives us a lot of inputs on any trends that are evolving, hopefully, ahead of the rest of the market. And that is something that really helps us shape the satellite piece of the portfolio. And I think, having access to this large research team also means that we don't necessarily have to straight jacket ourselves into a particular style of investing, that we'll only look at a certain set of companies which may meet a certain quantitative criteria or so on. We can pretty much be flexible in terms of what we want to invest in. But to the extent that there is access to this research team, that also means that we are not compromising on the rigor, whether it's the satellite bucket, whether it's the core bucket. I think that's something that helps us as an investment manager. I think from an investor's point of view also, it's very important to at least have this understanding that a lot of these trends are cyclical in nature, because if you are, for example, just evaluating a fund, you forget about direct investment and so on, that's even more complicated. But even when you are evaluating a fund, there's a good chance that today, if you were to look at the last 3 years of performance, you are likely to pick a fund which is very sort of value oriented or very cyclicals dominated and so on. But had you done the same exercise 3 years ago, and had you looked at the winners in terms of fund performances, then there's a good chance that you would have ended up with a consumer facing fund or a very quality oriented fund and so on. But that didn't work over the next 3 years, right? Something else did. And which is why I think even with diversified fund managers, it becomes important for investors to understand that there can be a certain style drift. You consciously, unconsciously, we all claim to be bottom up in nature, but there are people who are very focused on margin of safety while investing. So that essentially gives them a value kind of a tilt in terms of their portfolio. There are others who are very focused on structural growth and the longevity of it. And that gives their portfolios a more bias towards, quality and growth and not so much about valuations and so on. So I think for investors also, it's important to understand the style drift of the overall portfolio. And in the bare minimum, try to diversify across managers who are following different kind of investment styles. And that essentially would mean that while they are not sort of consciously following this core satellite kind of an approach, but at least through a diversification across fund managers and their styles, they are able to get the best of all worlds. So that one thing that we definitely don't want is for our portfolios to do well in a certain part of the cycle and end up being at the top of the chart, but then to completely collapse in a different kind of a market environment and end up being at the bottom of the chart. I think for long-term wealth creation, consistency is the key. And in that sense, having this diversification is something that should help portfolio managers, but should also help investors to a great extent.
In fact, Gautam, what I liked, what comes out from the discussions is, investing or investment management is not a very easy job as the people think that, and people think that I do it alone. But when you said you have a team of 40, 50 people who does this, I really want to get some of the clients who does it of their own to go and actually take a view how it works in the real sense. Ashish, in fact, the same questions to you because, I have always seen, when it comes to investing, for a businessman or an investor, maybe they have taken 20 years, 30 years on their career to reach to a level where they can invest crore of rupees. But when it comes to investment, they rely on unclassified sources and they expect return to come to you every minute. So what is your take, Matlab? How do we handle this, or what is your suggestions to the investors? Uh, you know, uh,
No, sure, Romit. See, this is something that I think, at least these days, all of us, while, we're talking of individual investors, I think markets generally are, overtly focused on narratives and uncertainties. And I think it's a period where it's kind of extremely difficult for anyone to remain sanguine and not get caught up in these narratives. Because, as you rightly said, a lot of these individual investors tend to, take clues from, friends and everywhere, and they kind of start looking at as if they can be managing, capital. I think, I mean, my only advice to everyone who's looking at investing, and in that sense, is basically that there should be a very strong investment philosophy and process that any and every investor should follow. And I say that because that is probably one thing that provides that investor an anchor when markets are in either in chaos or in euphoria. You don't tend to get carried away, and that's extremely important. Now, when I say, the person looks at investment opportunities, now it can be secular, it can be cyclical. I mean, the process is what drives it. It provides you with one investment thesis. What it tells you is you can only own what you can control. You can't really do too much of things without, having a process in place. It's important that, when an investor looks at markets, he should basically, as I said, the broader theme should be that he should look at owning high quality companies. Uh, my my take has always been is that the secret sauce of alpha generation is basically own businesses which have structural large time opportunities. The businesses have been having has steady, track record on earnings execution. And finally, I think the sector or the business has good growth prospects. If these are all in place, and the fact that you are paying reasonable multiples, I think you are fairly there. And that's the kind of hygiene and a process that investors should look at. Having said that, as I said, in today's times, everyone's caught up in narratives and uncertainties. So it's a very important factor that you have to have a kind of a process and a philosophy that you need to follow through. And I think that would be my suggestion to anyone and everyone who's looking at direct investments into equities.
Absolutely, matlab, let's fund managers do their job. Matlab, you do your business. We go to a mechanic to get our car repaired. So Kunal, just coming to matlab, probably we'll run short of time. There's a lot of excitements around India going up the GDP valuations and kuch khabar aata hai to India on the third, India on the fourth, and people don't understand what does it means for a GDP valuation is or it's going to impact. So as we talk about so-called the India growth story, and our economy riding up the GDP valuations, and this question is available to all three of you gentlemen. Matlab, which offers the bigger opportunity, cyclical or cyclical?
At this point of time, I think if your portfolio is balanced, well, it's a choice. I mean, how much to tilt. But if you tilt, I think the tilt towards cyclical sometimes is it's spoken of in a very almost as if it's a bad word. Cyclicals are not bad. I think what is required, and it kind of dovetails into your earlier question, when it comes to what investors should do. I think direct, if someone is trying it direct, or even for us as fund managers, cyclicals do pose a you do have to have that extra thing in your arsenal about good timing on exits, because there is the chance of sharp drawdowns otherwise if you get it wrong. Now, that sense of exits, etc., has to be guided by valuation and the fundamental underpinnings. I think the fundamental underpinnings for multiple pockets within our economy and stocks that flow through from that are strong for at least a few years. We see that in multiple stocks. So if you ask me today, I think on balance we wish to be more in cyclicals, and cyclical almost means that as if it's it could fall tomorrow, but I think some of the cycles can surprise us on the upside and the duration.
So Kunal, you say cyclical.
Yeah.
So you say cyclical. So I'll just move on to Gaurav because we are just running. Gaurav, Kunal says cyclical. You obviously you have three people, you have three, but we have to have a majority. So
Romit, I mean, I think one temptation that we all, and a very often used term in investing is to follow a barbell strategy, right? Where go to either extreme, buy very good quality and buy junk all to put together and hope that something will work. Our approach has exactly been quite the contrary of it. So we don't sort of follow a barbell kind of a strategy. There is a lot in between, right? You don't have to be at one extreme or the other. There's a lot in between where you can say with a degree of certainty that over the next 3 to 4 years, earnings are going to pan out in a certain fashion. And if those earnings will pan out, then those stocks will deliver. And today, as I said earlier, that we always tend to follow a balanced approach between both not missing out on secular opportunities and not missing out on cyclical opportunities either. So we work with that balance, and we are somewhere in between the barbell where there's a lot of
Gaurav, so Gaurav is politically, between secular and cyclical, where Kunal has been very straight. Ashish,
sorry,
so you have been.
Romy, just to clarify, to the extent that we follow that core satellite approach, we are always keeping ourselves busy with finding cyclical ideas while also keeping ourselves busy in digging deeper into secular ideas. And that approach is something that we continue to follow.
Super. Ashish, to you.
Yeah, so I would say, earnings growth coming from either secular or cyclical, we are hinged
जहाँ
up
पे
to
पैसा
earnings
बनता
growth.
है,
जहाँ पे
जहाँ पे पैसा
है,
बनता है वहीं पे
जहाँ
हमें
पे visibility है, earnings growth है, वहाँ पे whether it's cyclical or secular is not important. Important is you're buying it at reasonable valuations and earnings growth is visible. That's where we would
brilliant.
probably
In
put
fact,
up.
Kunal, I realized that I cut in between because you had said number one was cyclical and you wanted to go to the second point. So did I cut you or you had something more to say?
Not really. And just to qualify, when I said cyclicals, it doesn't mean 100% of the portfolios that I said where we tilt towards. And
Very
we
good.
actually, our portfolios are tilted like that. Over the last few years, we've come to a certain tilt.
3 advice to the clients and 3 advice to the distributors, because there's a lot of distributors who are connected to this. So 3 advice from Kunal, 3 advice from Gaurav, both the clients who are doing who are seeing this show directly, and 3 advice separately to this. Short, we have only 4 minutes time in our separately to our distributors and to the client.
So I'll at least go with a couple. I think that I have in mind judge someone over a medium term and not only on the last 1 year of how things have been. I think that's very important. Over the longer term, as we have heard about this, the signal comes up and separates itself from the noise. So I think take a longer view to judge a fund, a team, a process that has been followed. Be patient through drawdowns. Stay the course if nothing has gone wrong in the core process that one was doing. Please carry on. And in general, I think the last very important thing is don't go for fads. Be sensitive to valuations that are being paid up.
Gaurav.
So I think the first thing is that beware of narratives and stick to your asset allocation discipline. And you will have certain assets doing so well in a certain period of time that you're tempted to get in, but always keep your asset allocation in mind. The second point would be that within asset allocation, when you're choosing particular funds or securities, I think beware of just chasing the last few, and I think as Kunal already said, last few months performance. Beware of the style drift that fund manager is carrying, and always try to diversify across investment styles. I think that's something that is very important. And the third point is that always keep the long view. And I think I'll just summarize by saying that I think it's something that's said in with respect to trading, but stocks are supposed to be the hardest way of making easy money. So, so
I thought
beware
it
of that.
was my clients thought otherwise. They thought it's a money making machine, you know. Uh,
So I think yeah, that's all that I have at this.
Ashish, you come
Yeah,
from a very, you
yeah, I
come
think
from a house. Sorry.
sure. So from my side, I think that the key thing would be that focus on good quality companies and with decent earnings growth visibility for the next 3 to 5 years, which are mispriced or are at reasonable valuations. And the second and most important thing is invest in equities as as it being a marathon and not a sprint. Because it's very important to spend time in the market rather than timing the market.
I think brilliant. Matlab, we had a very holistic view on the entire, entire discussion. So as we come to an end, I believe that I am a student, and my key takeaways is, market it's far more complicated the way we perceive it. There are a lot of, there are a lot of complex processes. There are a lot of complex events which determines the outcome. There is a difference between buying a good business and buying it at a great price. So good business are not generally the best investment deal. So while good businesses is important, valuations is also equally important, and in fact more important. Gentlemen, thank you very much. In fact, I am sure with your kind of insight, everybody here has enriched their knowledge, their experience. And before I leave, my only suggestions to all viewers, please look into, I call it a three E. Look for experience, expertise, and educations of the everybody. So it's not a very easy exercise. All these people that you see, they are extremely experienced, they are all experts, and they are also very educated. So thank you very much, and wish you all the best. Over to you.